Well, hello and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. We're going to start in just a minute. We want to thank everyone for joining us today. We've got a lot of audience participation, a lot of people signing on right now for our mid-year 2022 outlook from Blanke Schein Wealth Management. And today is about 10:01 Pacific Standard Time. I'm going to give it a minute or two and let's get everybody in our session here, and then we can continue. And again, if you happen to be here for all of it or some of it, we're going to send this out as in its entirety. So don't stress too bad if you happen to have things to do. We understand everyone's very busy, but you can take this with you as we will play this and send this out later this week. Give us a couple more minutes here. All right, well, we're going to begin right now. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us on our mid-year outlook of 2022. This is 10 a.m. Pacific Standard Time. We've got clients all over the United States tuning in. We understand it's different time zones wherever we have clients from Maine to Florida, Hawaii, all the way to Alaska and everywhere in between. And we understand that you might not be here full time here in Palm Desert, California, because we're pushing well over 100. We're well into the summertime right now. But let's get right into it. Thank you for joining us again. Like I said before, if you miss any of this or you want to see it again, as if I move too fast, or you want to show it friends and family, we'll be sending out this broadcast in its entirety in the future after we're done here today. So let's get started here with Blanke Schein Wealth Management. You know, one of the pillars of our client success is client communications. Not only are we proactive on our client reviews, but we're also provide daily updates, whether it be email, and then we also have video updates 2 times a week. I try and provide the market insights and observations, what I see about markets, or we see sort of what we project going forward, not predict, but sort of what we can say, hey, what markets are paying attention to, so we should be too, and ultimately how we're positioning for it. We have our YouTube channel. It's growing. It's continuing to grow, and we thank you for that success, as well as clients share it with friends and family consistently. And I have well over 300 plus videos and lifetime views of over 70,000 hours. So we know it's more than just my mom watching all that YouTube time. So we thank you for clients staying informed and staying connected. You've seen Robert Schein, myself in the media lately, Yahoo News on March 21st, earlier this year. I talked about the choppiness in the market was directly related to the Federal Reserve's comments. We've seen the Federal Reserve consistently talk about what they want to do in shaping interest rate policy on a go-forward basis, you know, raising the interest rates. And we'll get into that later, later on our broadcast here. But as you can see, the Federal Reserve Chairman, as soon as he spoke, markets sold off. And that actually happened earlier in January, and it's continued that same pattern. In fact, Jerome Powell is speaking at Capitol Hill earlier this morning, and I updated our slides to reflect exactly what he said. So this is real time and real relevant for you. But basically, the ongoing tightening is something that's going to continue. And the fear is what's going to happen, whether they tighten monetary policy or raise interest rates so constrictive and so aggressively that they break the back of inflation, a la Volcker in early 80s, or the economy is going to break, right? Something breaks in the economy, something slows down further or faster than that what they have the chance to slow down the economy. So if something's going to happen there, I think that I want to put that quote there because it's very impactful. And we'll send out sort of our media sort of when I'm in the media, so you can catch us live. I've been in mornings with Maria this last quarter. Liz Clayman, I was just with her this last Monday. And, you know, obviously Bloomberg TV here, and it's our latest thinking. And it really came down to the success of our clients tuning into the YouTube channel. That got in the mainstream media, and the mainstream media picked it up. And now I'm, in the studio more and more, which is a great thing to happen. And we want to thank our clients for all that, again, that support and tuning in and that success as well. We both Rick Jr. and myself were just on the Forbes California State Best in State list. That was just announced in March. So we're very honored to have that, both 23 and 24 in Best of State in California. And Rick as well in 2021 was also next gen. So he's extremely rising star, no question about it. And it's great to see we're doing so well. But we thank our clients for that first and foremost, because we wouldn't be here if it wasn't for you. But HighTower overall is the backbone, so they help us help you, if you will. And HighTower ranks number 2 on Barron's list in 2021 as well. So our firm is solid ground. We're doing well. Over 115 individual practices, all under the HighTower umbrella across the United States, and well over 34 different states right now, and over 100 offices. And that $100 billion assets under management is an old number. We're significantly higher than that as a firm. So what's the success of our practice here at Blanke Schein Wealth Management, or HighTower in general? Is simply because we're accredited investment fiduciaries. I'll say that again, we're accredited investment fiduciaries. We have that designation. That's very significant. Ultimately, we're legally bound to do what's in our client's best interest. As we always do. That's how we were raised first and foremost. But in our industry, you want to look for that designation when seeking out a financial professional. We're all not created equally. The designation helps. It puts us on par with a CPA and a estate planning attorney in terms of that legal obligation oath that we take. And it basically is known as a fiduciary. The fiduciary puts the client in the middle. The fiduciary standard, the suitability standard says, hey, date, time, place. If it was good for you at that moment in time, you put the client in that product, and then you just move on. And those are the investment advisory days. It's actually a stockbroker. Those are the days of the past. So that's the dinosaur that's dying, if not dead at all. But the future is the fiduciary standard. Again, one of the pillars, as we discussed, is education. We have the financially empowered women. Education for women in wealth and wellness. And I have a huge passion about that. I personally am a minority in a sorority, 3 girls and my son. And it's all about educational empowerment, especially I start with my mom and that personal story. If you want to follow along on the Confidence Summit, you can go to cw3confidencesummit.com and our social media handles, and we'll get the latest information, latest education for you. And in the fall, we're going to pick up a series again. So it'll be fun to attend in person as well here if you're in the desert. Again, the long-standing approach, Blanke Schein Wealth Management, we're built for the next 40 years with Rick Jr. and myself, but Rick Sr. and myself, the last 40 years, with Rick Sr. 40 years. And I was with him the last 20 years, 22 years. And so we're basically a multi-generational family practice. And so why that's important, one, our family takes care of your family and multiple generations in your family. We've had a lot of success with that. So, mom and dad or grandma and grandpa, Rick Sr. was there, and I'm in the middle of that. And the next generation has different needs and different concerns, and actually different questions about the market. Rick Jr. is phenomenal at that. But we bring the family together. We keep the family together. We talk about transferring what's most important, which is the values within the family. It's different value structure, which is fine, depending upon the family, but also the importance of the hard work of the family business or the wealth that's been created and generated for the next gen. And so Rick and I help bridge that gap, and we have that. But we also take a long-term view on the markets. And so we bore our clients to wealth. We don't excite them to poverty. And so it's very important. That's because of our process. Our process is really what keeps our clients very engaged and successful. Again, communication is key for us. That's why we're joining you today. But a lot of clients come to us, or even referrals. This year is our best year ever in terms of referrals. So we, again, thank you for that. When somebody sits down with us, let me see if I can get this little highlighter here. The key thing is about the lifestyle. It's all about the one in the middle. Maintain my lifestyle, improve my lifestyle, so that, again, if I'm retired, I'm permanently retired and I can take care of the next generation. And that's important because the lifestyle really talks about the income. We look at the income it provides and the preserving the legacy. And they really come to us with the investments. But the critical thing here is the healthcare. We also want to make sure that the legacy is set up with estate planning. We'll do estate planning reviews later this year for our clients. as well as healthcare. That could really derail a perfectly well-run plan. So we have to look at preventative care, obviously long-term care. If there's anything here on this, we'll talk about, because we want to maintain the lifestyle and the investments as well as the income. Again, our financial planning process is what really is the key to our success here for our clients. So if you have not engaged with us recently about updating your financial plan, we're talking about things you want to do in the future, please let us know, and we're happy to do that. Again, the 5 pillars are your financial plan, the education, the guidance we provide, our process, investment process here at Blanke, Schein Wealth Management, and the service we provide. Both Sherry and Leslie are second to none. And if you need anything, they're the ones that will get it done, and we're here to support them as well. So we're grateful and blessed for our service team here. And of course, one of the keys of being independent is that we have access to everything. All the sell-side Main Street investment resources, the Morgan Stanleys, the Merrill Lynch's, the UBS, every daily packet of information we can get, we have on a daily basis in terms of research. But the independence of independence is really where we drive most of our stuff from Strategis and a few others here. But again, that's just showing that we have a conglomerate of independence. That's really what drives our advice for our clients, which is great. It's unvarnished. And we'll move on. So why am I feeling more confused than ever before in today's economy? This really sums up where we are, where we've been, all the concerns that we're thinking about or even feeling. The 2 main drivers right now are the energy, basically energy policies of today in the United States and the Federal Reserve. The Federal Reserve, Jerome Powell, is really driving the markets and spooking the markets, quite frankly. We're seeing markets trade down because of higher input costs, because of inflationary pressures, also because of higher costs of just the savings rate in terms of or the lending rate. So we'll get into all of that. And there's obviously inflation and stagflation fears, and there's also Congress here, and Congress does play a big role in this as well. Earlier this week, we're in a bear market, and the bear market is by a technical definition of down 20% or closing down by 20%. The NASDAQ is well in that territory, close to 33, 34%, and it's low this year. It's bounced from the low. And the S&P 500 is 24%. We closed down that last week. So we are in bear market territory by that technical definition. And in a bear market, what do we turn to? We turn to those who have been there, done that many, many times. I was on Liz Clayman on Monday. And Liz talked about, she had me on the show and said, ultimately, what are you advising your clients right now? And ultimately it was, the way I put it in perspective is, we look at Warren Buffett, what has he done this last quarter? In the first quarter of 2022, if you look at their positioning, he put $51 billion to work and invested in 8 different companies, some new positions, some doubling down on existing positions. So he rebalanced his portfolio and he upgraded his positions. He booked gains. He also booked losses. Warren Buffett just doesn't have winners. He also has losers. And we all do it. It comes with the territory of investing, if you will, is how do you use this bear market to upgrade your portfolio, as evidence is what Warren Buffett is doing right now. And I talked about the 4 Ds of a bear market. You want to say disciplined, which we are. You want to say diversified, which we are for our clients. You want a dollar cost average. So if you see opportunities come our way, we dollar cost average into something, and we can never catch the bottom perfectly if we want to open up a new position on a quality company that we like for the long term. So we'll enter into it. And if it goes down, let's say month over month, we'll buy some more. That's called dollar cost averaging. But we know that the average price, ultimately at the end, a year from now, 2 years from now, 5 years from now, our clients will be really, really happy with that outcome. And the final D on this one was the dividends. We're looking for cash flows right now. Of course, Warren Buffett's stock right now doesn't pay a cash flow, as I said on Liz Clayman's show, because he keeps those dividends. He keeps that $39 billion worth of cash flow, and he keeps it and redeploys it, his team, to look for other investments to invest in, stock buybacks, so on and so forth. Again, he's finding value in this bear market, and as are we for our clients. What's today's market outlook and recap and overview? This is sort of what the same slide I had earlier this year on our outlook in January for our clients. And the first five are the same five right now. And the bull market enemy, which now we flipped that to a bear market. And this is what I forecasted earlier this year, are rising oil prices and higher interest rates, right? Still the main concern. The geopolitical concerns, the Ukraine-Russia, that was, it's unfortunate that's happening right now. It's very disruptive geopolitically, but also economically, and we're feeling the impacts of that here around the world as well. Midterms, we'll discuss a little bit the impact of the midterms, what that looks like later this year. Valuations, the risk trade is unwinding, and we'll go into that. And then portfolio positioning, value versus growth. And I touched on it this last minute or so, which is value-based investing, or those that pay a dividend are basically going to do well or outperform those sectors of the economy, as well as active versus passive. And Blanke Schein Wealth Management, we are active, and I'll go into our process there, as well as what to do with cash. If you recall, if you're a client and we had many discussions in November of last year, we raised a lot of cash for our clients in our balance sheets, anywhere from 5, 10 to 15%. And that's significant because outside of Blanke Schein Wealth Management, clients have cash as well in the bank. And that's not paying anything, but we raised more cash. And the conversations that we had with clients, as clients said, hey, Rob, Rick, why aren't you putting the cash to work? And if you saw how it played out the last 6 months, cash was king. We kept it in cash. If we put it in fixed income with rising interest rates, bonds would be down. If we put it in the market, which we've dabbled and we've repositioned some portfolio, we picked up some positions that we like, we've seen lower lows. So cash has been a good sort of asset class that we've been hiding out in. We're still waiting for lower lows later this year. But for most clients, if not all clients, we have a significant relative to their portfolio cash position. And that's by design, and that's being proactive here at Blanke Schein Wealth Management. What to look for in the next 6 months. Now, here's what's important. The next 5 things are probably not going to be the best that we're going to discuss right now, but they're important to do because it's going to give us the guidance of what we believe could play out. Earnings revisions. Next 2 weeks, we want to keep our eyes and ears open to corporate America as they go into earnings revisions. Keep in mind, year to date, corporations are producing a 10% growth rate on the top line revenue, and it's projected for the S&P another 10% next year. So earnings are growing, and earnings drive markets higher. That's why we're always believing in the stocks for the long run story, as Jeremy Siegel points out. That being said, right now, if you're running a company, why wouldn't you take this opportunity, as the previous slide I just showed, all the different things that are happening, supply chain, war in Ukraine, geopolitical unrest, energy, wage inflation and everything. Why wouldn't you take the opportunity to give a cautious, less than rosy outlook? And so we could see earnings revisions from all the C-level executives on all the corporations because they have lack of visibility. They don't know when all of this stuff is going to end or how it's going to end. So we're going to see, we anticipate corporations to come out over the next 2 to 3 weeks before the quarter end and basically give negative or downward guidance, even though earnings are still growing by 10%. Markets may have not seen the lows of the year. So we could expect September, October, lower lows. A lot of the market fundamentals are setting up that way. The moving averages, all the statistical analysis and the fundamental analysis that we're looking at could show S&P even lower than where we are. And that could be an event. We could see a bounce right now of 10% on the equity markets. And, bounces keep bear markets alive, but we have to also wait and see lower lows. We're getting to lower lows where we could see the sellers are exhausted and we're getting through this bear market. We've got more of it, about 70 to 75% of the bear market behind us right now. And we're getting close to seeing light at the end of the tunnel. And I assure you, it's not a train, but we've got to go through this process, this bottoming process, and it's never fun. And I'll get through the strategy and how we're guiding our clients and positioning our clients as a result of that. What we're also looking for is by the end of the year, as weaker data comes out economically, the Fed potentially could pause. Keep in mind what they're trying to do. If you're on a golf cart and you're going super fast, they're putting a governor on the golf cart. If you've ever been on a golf cart, it goes super fast, it slows down automatically. They're pumping the brakes on the economy. It's the same analogy. So they're trying to slow us down for a soft landing. We'll see if they can do that. And they're going to get weaker data as a result from different areas like the real estate market that's super hot. They're trying to slow that down intentionally. Again, they're trying to slow it down. Hopefully it doesn't break. They're just trying to get and engineer a soft landing. So once they see that and they achieve that inflation's rolled over, they potentially could pause for a little bit if they're happy where the 10-year treasury is and interest rates are at the time. So there's a potential late this year or early next year, a pause in the Fed. Once we see that, that's extremely bullish. We could see the bull market return very, very quickly if that case happens. Market reversal, that's again short covering any positive news, and I'll talk about that. That's a potential in this market right now. And then the midterms later this year. Again, this is not a political statement. It doesn't really, historical data shows on the markets. It doesn't matter who's in the White House, if you're red or you're blue. Again, our clients like green, so that's the most important thing. So we have to position our portfolios accordingly, but historical data shows that if you have a divided Congress, which we potentially could see, if not almost assuredly see, let's say the House or the Senate or one or the other, or if not both, we could see divided Congress, that's including the presidency, that would stop the spending. Part of the inflationary story right now, part of the problems that we're in right now, is there's too many dollars in the system chasing too few goods and services, right? Where if it fits and starts because of supply chain and reopening after COVID. We don't need more spending. We don't need more debt. Fiscal and monetary policy need to contract, not increase. And I think that could be a very big positive, because at least the next 2 years after this midterm, you could see no more spending, and markets would take that as a very big positive. Now, what's the bear market playbook, Rob? Here at Blanke Schein Wealth Management, we have a process. We've been through bear markets before. We've been through market pullbacks before. Our most recent technical bear market down by 20% was March of 2020. And it's the start of coronavirus, where the whole economy stopped, and that was a government shutdown, global shutdown, if you will. At that time, we had markets trade down really quickly, really rapidly. Again, why you have us on your side is because we rebalance really quickly and really rapidly. In this case, we did a strategic rebalance for our clients, and we saw high quality companies at a super big dislocation and trading down evaluations that we saw very appealing. So we traded rebalance out of fixed income and into equities. On the chart shows a historical asset allocation of a book of business here. And so we traded about a 10% rebalance, where we sold fixed income and we bought equities. And that strategic rebalancing, again, proactively, both in March and April, set up for tremendous returns on a go-forward basis for our clients. Again, we're waiting for that opportunity. Once again, as I said, we have cash on the sidelines, we have fixed income, we even have some areas that we have maybe some underperforming equities that we can rebalance, and we can do the strategic rebalancing. Now, we do that on an ongoing basis, okay, consistently for our clients, but we also do it when we see significant down days or significant opportunities, as we did in March and April of 2020. And for those that are clients that are with us that are strategic withdrawals, that are cash flow oriented, part of our process that I really have never spent too much time on this, speaking to this, the greater sort of bigger picture, is when our clients need, let's call it $2,000, $10,000, $20,000 a month in terms of cash flows, where Sherry will send the money to the bank. For our client's bank, and we take it out of the withdrawal of the portfolio. Both Rick and I strategically, every single one of our withdrawals, every single one of our clients, it's not an automatic withdrawal. Okay, we don't have that set up. We go into each one of the client's accounts that requests. We have a process, we have Salesforce, we have tasks, and we have a whole system in place that captures us to basically task us to go into that client account. And we look at the best, highest, and best use of, hey, listen, if markets are up as they were last year, we would sell a little bit and then distribute that distribution to our client for that month's cash flow need. Or if markets are down, we say, hey, listen, we're not going to sell something that we believe will be bouncing back between the next year or even 6 months from now, because we don't want to sell it while it's down. Why that matters is the decisions and the timeliness and the detail, the attention to detail and the withdrawal process that we do here at Blanke Schein Wealth Management really makes a long-term impact, both mathematically, but also lifestyle for you. Long term. We've been doing the last 40 years. We're going to be doing that for the next 40 years. And that's part of the success that we have is cash flow oriented clients. We are very attention, detail oriented, and very mindful of where we use the highest and best use of the withdrawal so that your money lasts a good long time. So crisis, Wall Street, there's always a headline to always pay attention to. And I say, I want our clients to pay attention to their accounts. I want you to, pay attention to your statements. I don't know if you should be tuning into the daily news cycle because markets climb a wall of worry. This is an important piece that indicates the S&P 500 since 1970 to 2000, basically this year, 2020. This chart could go back even further, basically 100 years back. And on the chart, essentially just shows all the reasons, calendar year of why not to invest, the negative headlines. The headline that says it's different this time and the markets are going to stop and they're not going to reverse from their downtrend, or something to be fearful of and worry about because it's going to turn the market or the economy around. And there's a whole bunch of them on here. There's probably a whole bunch of them that we couldn't put on, that aren't on here, but we could put on here. The reality is if you put in $10,000 in the S&P 500, reinvest the dividends over that same time period, you'd have $2 million. Okay, if you listen and tune into the news, you'd be in the market, out of the market. We're not traders, we're investors for our clients. And the long-term average over this time frame is well over 10%, so 10.67%. So we look for the long view. This is just showing us that there's always going to be a negative headline out there. But then we can't sidestep that the history of bull and bear markets. Again, as I said before, we're in a bear market right now. Okay, technically the market's closed down by 20%. Now, let me read this to you right now. The chart shows the S&P 500 and the bulls and bear markets since 1942. We believe looking at history and market expansion and recessions help gain perspective and a fresh approach and benefits in long-term investing here. The average bull market is about 4.5 years in this period of time. And a cumulative return on average total return is 153%. The average bear market is 11.3 months. We're in about 6 months right now. So as I said before, we have a little bit more to go. We don't know. This is an average here. It could be longer, it could be less, but the average is 11.3 months. And the drawdown is 32.1%. We're there on some of the indices right now. The NASDAQ is well into the average of that, down 32%. The S&P may have some more room to go. On this chart, you're going to see right here the shortest bear market in history. Oh, and that's right here in 2020. Let's see if I can do this properly. Right here in 2020. That's the shortest bear market in history. So right now, everyone's saying we could have, here's other bear markets. The grays are bear markets. Some of them, like this is in the great financial reset from 2008, 2009. And then previous recessions. So recessions are part of the process here. And whether you believe Larry Summers, who says we're in a recession, or if you believe Janet Yellen or Joe Biden, who says we're not in a recession, I kind of think we are in a recession, I think. And I'll go into why I believe that. And then the Federal Reserve is basically trying to, by their definition, engineer a soft landing. And this morning, in quotes, that's the goal. That's what Jerome Powell said. That's the goal of a soft landing. Well, on the right-hand side, if we look at a 60-40 portfolio, 60% in stocks, 40% in bonds, this chart shows going back to, again, 1977 all the way to year 2020. Year to date in 2020, in the bottom right-hand side, you're showing if you have a balanced portfolio, even the balanced portfolio this year is getting hit super hard. Not as hard as obviously the equity markets, but even stocks and bonds. Bonds are going down tremendously this year. Okay, they're getting hit hard. So right now, year to date, a balanced portfolio, 60-40 is down 18%. Our clients are faring better than that relative to. No one likes to be down, but all of our portfolios across the spectrum for our clients relative to what the markets are giving us, we focus on downside protection. So we're not going down as much as the market, so that when markets turn around, we don't have to recover as much as needed both mathematically speaking, but just obviously on your statement. So we'll recover quicker and faster. We've done so in the last 40 years. We'll do so as we engineering our through this and navigate through this bear market as well. But this just shows you, if you look at this chart right here, that both stocks and bonds are getting just hammered this year. The last time that happened was 2008, the great financial crisis. But historically speaking, if you go back, look at all the green returns, even in the 70s, the balanced portfolio, when we had high inflation, when we had all the negativity, a balanced portfolio in the late 70s, early 80s, look at all the 80s returns, a balanced portfolio won out. And there's a lot of reasons for that. So it just shows that that's what we have here for our clients at Blanke Schein Wealth Management, 70, 30, 60, 40. For the most part, if you're younger, you're going to have less bonds in your portfolio, more equities. But ultimately, the destruction has been real, at least on paper, year to date. And let's take a look at this. On the left-hand side, stocks and bonds. If you take the stock market and the bond market, again, like I said before, the bond market's been hit almost the hardest this year to date. Simply because when interest rates rise, bond prices go down. But if you combine the loss on paper for both stocks and bonds, it's $16 trillion year to date. Okay, that's 8 trillion more than the great financial crisis, because the great financial crisis is more equity. So we've had a bigger wealth destruction than we have even in 2008 right now, and it's happened rather rapidly. Now, the next component is, these are the three cascading bubbles that I think the Federal Reserve is going after, and that's why I listed them. They're going after the stock and bond market, they're going after crypto markets, and then they're going to have to real estate market, and that's what's happening right now as we speak. And I think there's been 6 months increments in between, and that's what we've seen the result. So as an example, stock and bond markets 6 months ago started selling off. Crypto markets this last month have just went through, they call it the crypto winter. Now, our clients don't invest in it. We really, Rick Jr. knows that market, but we don't advise on it. We have a lot of clients with next generation that have a lot of next generation, their kids and grandkids that know all about it. If you have questions, we're happy to answer those, but we don't put that in the client portfolios, if you will. And so why that's important, why that put that up is because it was before, at the beginning of this year, the crypto market was a $3 trillion market. And cryptocurrencies were thought of as a gold replacement. Cryptocurrencies are relevant because it's going to be the future. And cryptocurrency was a store of wealth of $3 trillion or an inflation hedge. Well, we just saw that $3 trillion marketplace just evaporate $2 trillion within weeks, this last few, several weeks, and definitely year to date. And it's less than $1 trillion in that marketplace. Now, what survives and when and how and what, that's a sideshow. And that's something where we can discuss on a later date on a one-on-one basis. Like I said before, we do follow that market, but we don't ultimately provide advice or invest in it. That being said, it's important because it's the wealth effect that the Federal Reserve is attacking, again, a bubble it's trying to pop, because there's too much dollars out there circulating in the economy. Again, a lot of people got stimulus, they put it in the cryptocurrencies or even trading accounts, and they ran the market up, younger generations, while they had nothing to do, while the world stopped in 2020, 2021 because of ultimately what we had with COVID. So that timeout has stopped, everyone's getting back to work, and now people aren't paying attention, and that wealth is just being, easy come, easy go. Again, that's a wealth effect of $2 trillion out of the marketplace. Couple that with the stock and bond market, wealth effect out of the marketplace. We're in a recession. Like, I don't know what to tell you. We got inflation 8.6%. The Federal Reserve is trying to engineer a soft landing. I don't know. They're hitting the real estate market. Real estate market now, 6 months later, we're going to see all of what's happening today actually play out in the real estate market. The softening has started. 1/3 of listings right now in the last 3 weeks have seen a price reduction, and mortgage rates from the very beginning of the year went from the mid 3s to the mid 6s. That's putting more than just the brakes. That's putting the emergency brake on the real estate market. So we're going to see how that plays out. But all of that is going to be a cascading effect of a negative wealth effect, negative consumer confidence effect. That's the concern moving forward. And as I said, short covering could be the largest short covering in history. This is a chart I want to show you that we see behind the scenes, where we have confidence in the future, but in the short term, it could get rocky and more volatile. There are a lot of short traders betting, meaning those crypto wallet people or those Reddit or all of those Robinhood investors. Small investors, non-institutionals, are all piling in on the downside by buying puts or betting against the marketplace. And we see that in evidence right here. And this is playing out right here on the far right hand side. Why that's important is because you also want to know behind the screen or behind the curtain what's happening in the marketplace and why we have this volatility. Now, as I said to our clients before, and I'll say it again, small traders are getting killed. That's exactly what needs to happen. We needed to see a flush out in the crypto market. We need to see a flush out in the people that are betting against this market. Again, we could still see more downside. But ultimately, the estimated losses on the traders are tremendous. Those are off the charts right now. Now, again, I say traders. Our clients aren't traders. We are long-term investors. If you're a trader, you need to sell for liquidity. You need to sell to protect your position. You need to sell because you're in today, you're out. Our clients are long-term. We own high-quality businesses that will be there for the next 10, 15, 20 years. And we're the best run businesses. And when we have a recession, those businesses don't get weaker, they get stronger because the weak sisters all ultimately basically feather out of the economy. So our clients are investors and we don't have to sell. In fact, we take advantage of it. Now, Rob, Rick, if you knew that the market was going to slow down, or if we wanted to get out of the market, which we did, we put some cash on the sidelines, but we're not going to push the button and hit all the capital gains, if you will, and then try to time the market once on when we get out, but more importantly, try and time it twice when we get back in. That has been a failing strategy for the last 100 years in the market, and we don't want to be against the market because, again, I just showed you all the short interest or all the people playing with the market. Again, there can be short covering, so they have to buy their position back at some point in time. So when markets stretch like that, you happen to know that at some point in time, that reversal could be huge to the upside, just like it is to the downside. So this is a chart that I want to bring to your attention that shows what happens if you miss the 5 best days in the market. And so this just shows the growth of $10,000. If we put $10,000 again back in the S&P 500 in 1979, okay, to just this last March, and you say, hey, listen, I just kept it in, reinvested the dividends, that 10,000 is worth, in this case, $1.2 million. But if I miss the 5 best days, okay, meaning I didn't time the market properly, I would only have $782,000. Or if I missed the 10 best trading days, meaning the upside days, right? We could see a market go up by 6, 7, 8, 9, 10% in one day. If you miss those days in this particular scenario, you don't have the 1.2 in one hand, you have the $500,000, just over $500,000. And if you miss the best 30 days, I want to sit out. I don't want to watch the wall of worry. I'm fearful, Robert. I'm fearful, Rick. You're basically missing out on $1 million if you miss the 30 best trading days. And if you miss the best 50 trading days, you might as well not even be in the game because you're only up $90,000. So you really can't time the market. That's a great historical sort of lesson that we like to bring to the forefront. Now, why do we need to stay invested? And what's the most important to our clients right now is the CPIU. As I said before, the government reading of the CPI is 8.6%. Okay, but I call it CPIU. Our kitchen table economics is most important. In that case, it's double digit. Now I've got 4 kids. I've got, a huge grocery bill. I've got a lot of, vehicles, energies, gas is very important to the Schein family. But education right now, we have a lot of private schooling for us. So that's double digit rate of inflation for that. So I have to invest to stay ahead of that. I have to have my money grow to stay ahead of that, to afford that, to maintain our lifestyle and maintain it growing so I can maintain college and private schooling. Our clients are in the same boat with our healthcare. Healthcare is a double-digit rate of return in terms of inflation, as well as our staples, right? Those are rising. So we need our investments to grow. They're contracting right now because the market's trying to discount how bad the recession will be. Chances are a recession won't be as bad. Housing as well. The housing right now, most of our clients, if not all of them, are, have their home, they own their home, and they're not worried about another home right now because the cost of home prices are rising, but the cost of housing and affordability is rising as well. So all of that is the biggest risk to our clients right now is in the future, the 2 years, 5 years, 10 years, because why? You're going to live longer. And you're going to need your money to grow ahead of the 8.6% inflation. And we spend more money on things that have double-digit rate of return. And if you've traveled lately, even on the airlines, an airline ticket right now, those are off the charts. Even vacationing, the hotels are being charged off the charts. So we need our money to work for us, work hard and smart. And that's what we're doing here. Now, if we look into what drives markets, earnings drive markets. There's a significant discount right now and a significant fear being placed into the uncertainty of the markets are down 30%. Okay, so markets are down 30%. The last quarter revenues for the S&P 500 grew by 10%. This quarter, the revenues are expected to grow by 10.3% if you look at all 11 sectors of the S&P. Some more, some less. Energy is going to grow by 54%, obviously, right? Financials are going to shrink a little bit in their growth. But if you factor them all together, again, all the sectors, we're going to see growth of 10% projected earnings growth. And the next year as well, 10%. So if earnings are growing and stock prices are going down, what seems to be the issue? Why is the stock market down? It's the inflation is the multiple compression. It's a technical word. The best way to think about it is it's kryptonite to Superman. Superman at earnings and corporations that are growing, and kryptonite is basically the thorn in the side right now. And the big unknown and the big fear is right here. On this slide, what I'm showing you is this is the average S&P 500 price to earnings ratio, and then the CPI year over year tranche. So going back to 1950. So the best way to think about it is if CPI is in this level of anywhere from, or inflation, 2 to 4%, okay, which is a long-term historical average, then the forward PE price to earnings ratio, or the multiple on earnings relative to what we're seeing is 17.4%. That's the average, okay? It's the 10-year average. It's also the 5-year average. So this is the number right now if we have an inflation rate under 4%. What's our inflation rate, Rob? 8.6%. We're double where we need to be. So the stock market, the S&P 500, right now, we're at 17. So we're under the average. But do we go from 17 all the way down to a 10? That's what the market's trying to price in, meaning that stock prices have to come down if inflation rate is truly going to be stubbornly at the 8% level, okay? Now, we don't believe inflation is going to be at 8.6%. In fact, we potentially could see this number rolling over. And that's why we believe if we see this number coming down a little bit, therefore we could see an equity rally or stocks rally. But in the meantime, we have what's happening right now is downward pressure on the markets, because we don't know if we're going to have persistent 8%, which is the range that we're in, long-term inflation. And that's why the Federal Reserve has to raise interest rates to stomp out and temper down inflation fears. This is the whole story right now. Are markets fair value? If interest rates, or excuse me, are equities fair value? If the answer is no. So they could go lower if the CPI is persistently stubborn at the 8.6% or goes higher. But if we see a crack in this number, again, why would we? Well, we saw the wealth reduction effect, consumer confidence coming down. People are going to spend less. You're going to go from what you want to spend money on to what you have to spend money on. So there's going to be an equilibrium. We believe that this will subside a little bit, and that's going to provide some relief to equities. Now, that's sort of the good with the bad news. Now, another question would be across our desk for clients is in the S&P 500, can S&P or can stocks rise in a rising interest rate environment? And the answer is yes. These are all the historical performances going back to 1961 to as most recent as 2016 to 2019 interest rate hiking, the Federal Reserve hiking cycle of interest rates. So this just shows the average annual return of when interest rates go up. Think about this. Interest rates have to go up because the economy is strong. Okay, so that doesn't mean stocks have to go down. So I just wanted to show you annualized performance. And if you think about early late 70s, from 1977 to early 80s, 8.2% was the average market return annualized. Early 80s, 83 to 84, 13.2%. And the late 80s, we had 24%. So once we get past this inflationary scare and we get it out of the system, we have equity markets rise. Now, I talked about midterms and midterms versus non-midterms election years. This is from First Trust. And what this shows is the midterm year is in blue, the midterm year, sorry about that. The midterm year is in orange, the bottom line of the market performance of the S&P 500, and the non-midterm year is in blue. So non-midterm years from 1950 to 2021 just shows that the markets start off in January in this blue line, and it goes to December, has its ups and downs, but on average over that period of time, if we look at just non-midterm years, markets are pretty favorable. It's pretty smoother ride because there's less uncertainty. So if we go to midterm years, which this is a midterm election cycle, from January, we have a bumpy ride, bumpy ride, bumpy ride. So we're still in February through, let's say, July, August, September, we're still having a bumpy ride. Once we get closer to October, and again, look, this is the election. There's always election uncertainty, and then we get certainty. We see that the trend or the bull markets persist once again. That's why we say, hey, got to stay in it to win it. And the next shows, well, it feels like this year's pace of movement is matching early 80s, right? 1982, I showed the chart below. There's also research that supports the first term presidential midterm cycle are very similar to this chart as well as in 94, 98, 2002, as well as present day. You have to take out 2008 because that's the great financial crisis, but also indicates that we could still see lower lows, as I said, later this year. And why is that? Because we're right about here. We're following along. So we could see a retest later this summer right here. But once we do that, those valuations, and something's going to break. The Federal Reserve is going to have to pause, CPI is going to roll over and come down, and then we can see markets resume because they've already had a healthy correction. So we're in 2022, again, 40 years ago, in 1982, the market seems to be matching. Midterm elections, this is strategic. Probably, basically, the opportunity is there. Okay, so S&P correlation and one-year performance this is it right now. The average drawdown in basically a midterm first-year presidential cycle from this is a 1962 to 2020 shows an average drawdown of 19%, and the bounce back year after that is 31% on average. Okay, and then this is the average S&P before and after the elections and midterms. Again, those are all the sample sets excluding 2008. But midterm elections show that markets love certainty. You can see this trend resume. Also, this is recessions before and after. So the 6 months before and during recessions, these are the market performance as measured by the S&P 500. This goes back to 48, 53, 57. These are all the periods of time where we've seen markets bottom, okay, or recessions that we've had. And ultimately, if you know this, if anything, if you've been through a recession, once they declare recession is the time when essentially equity markets usually take off, because most of that has been priced in. As we've seen, the front end of the first 6 months, they're pricing in worst case scenario on all these equity valuations. Now, the 1 year after this recession, 3 year after, these are average returns of all those historical markets going from recession and expansion. You're going to say, hey, listen, Rob, this is really, I'm glad you showed me this chart, because the historical average, history's in our favor as we look at the last recessions and say, hey, listen, you just got to get through it, hold quality, and understand that we will get through this sooner than later. Obviously, 2001, we had a little bit longer to go, but markets were still recovered and recovered rather nicely. And so what did we learn today? Again, we're on the 50-minute mark right now, and I appreciate everyone joining with us and staying with us. Ultimately, we are, and for our clients, we are investors, not traders. There's a lot of trading behind the scenes in the market. There's a lot of shorts in the market. They will have to cover. they're shorts. They'll have to, you could see aggressive moves to the upside once the downside flush has finally stopped. It's time in the market. We showed the historical performance of not timing the market. You don't want to miss the best 5 days or 10 days or even 30 days. You'd be really out of the game to say, hey, get me out. It's okay to push some cash in the sidelines. And for those clients who have cash in the bank right now and say, hey, listen, give us a call. We'll talk about just putting in the account. We'll just sit there and wait for opportunities to come our way. Same quality as protecting us on the downside. Those companies don't go down as much because the quality is there, the value is there, but they don't go up as much. Okay. So we can't let's do the relative performance on the upside. Say, hey, we're slow and steady. We'll bore you to wealth, not excite you to poverty. And finally, the inflation is our largest risk. The markets are telling us that, but we don't need markets to tell us that. You and I, you're living longer and stronger than ever before. And so we need your dollars to outpace inflation. And the inflationary playbook is you want to own assets like equities and real estate long-term. Short-term, there's always going to be a recession. There's always going to be a pullback. We look at that as opportunity for the longer-term investor, as all of our clients are. Well, we thank you for today. Thank you for tuning in. Again, if you want a review or a recap, or discuss on your personal situation, we're happy to do that. If you want to refer us, take a long-term perspective like we do. Again, we're blessed to do that. We thank you for that. You can refer anybody, anytime. You guys have a wonderful day, and thanks for tuning in. Until next time, we'll take care. Bye-bye.